Hi, I'm Craig Svendsen. I'm Defined Benefit Team Leader here at NEPC, and I'm here with my colleague Chris Levell, who's a client strategist at the firm. Chris, these are complex times for corporate defined benefit plan sponsors. Can you talk a little bit about some of the trends you're seeing in the industry?
Sure. We can look to our survey that we do every year, and it's interesting to look how that has changed over time. I think there's been a lot of focus recently on risk transfer. That's something that's been around for a while. Certainly people started doing, I think in a large part, deferred vested lump sums starting in 2012 when the laws then changed. But now each time, especially as there have been interest rate opportunities to offer those lump sums to participants, those have come along. And now we have the specter that, I'm an actuary, so I have to mention mortality tables sometime, right? Now comes the fact that the mortality table rules on lump sums is going to change sometime. It's now expected not to occur until 2018. So in the next couple years, if people offer lump sums to deferred vested employees, they're going to be at the current mortality table, which is a little bit more favorable. There's some challenges with that, though. So you're offering something to a deferred vested employee that if they ended up getting an offer a few years down the road would actually be more favorable to them. So our clients are looking at different ways to make the offering and really make it a nice opportunity for their participants, but be clear on what all the trade-offs are in getting the cash now.
Do you have a view on how the implications of that from an investment perspective?
Sure. When one of our clients decides that they're going to be doing a lump sum offering, we work with their actuaries to determine what the expected take-up is, what percentage of people are going to take the offer. That then actually is a part of the assets that really doesn't have duration risk. So if we've had a developed liability-driven investment or LDI hedge in place, if we're along a glide path, we now have that portion that's going to go out in lump sums sometime during the year. The interest rate's already known. So we'll work with the client and we'll actually often decrease the overall duration of the program and raise liquidity to pay out those lump sums.
Do you see these trends that you identified continuing well into the future, or is that more confined to kind of a near-term horizon?
I think that's an interesting question, and it remains to be seen. I think that certainly if you look at our clients that have not done any of these offerings, they're either doing them this year or they're talking about it this year. So this could be kind of the peak. One concern out there is that if you do these offerings every 2 years and come back to employees who've already seen the offerings, you now start to establish a pattern that you're offering, and the regulations aren't going to allow that to be a window anymore if you keep on doing it time after time after time. So we'll probably see them decrease over time. The other thing that's interesting, and certainly the other big risk transfer option that's happening, is actually purchasing annuities. And I think that industry has, we've always had plan sponsors that have frozen plans and decided they'd like to exit the pension business, who've done annuity purchases to terminate their plans. But now we're seeing more risk transfers where people are taking a portion of their retirees and annuitizing those. So it's a partial risk transfer. And the coordination of these deferred vested lump sums and these annuity partial transfers has meant that the plan sizes are going down in some cases.
Many of the plan sponsors are taking these actions at a time when their funded position is still well below 100. Do you think they'll be revisiting all of their options if we do get that higher interest rate environment that people eventually call for, that will lead to higher funded status levels, to where there might be even more additional flexibility for plan sponsors to de-risk their plans further, or, as you had mentioned, to get out of the pension business?
Yeah, our survey clearly shows that people, I would say you're exactly right on what the typical plan sponsor has said. The typical plan sponsor says, look, we're on a glide path. We're below 100% funded now, probably around 80%. Over time, we expect to be higher funded, and we're going to get that way because we're going to get good returns on our risky assets. We're going to have higher interest rates, and we don't have a perfect hedge in place, and we may make some contributions. So as they've worked down that glide path, the interest rate portion of that hasn't worked.
Right.
We haven't had that period of higher interest rates. Everyone's expected it. we probably will see some higher interest rates, but it's not clear that we're going to see them at the point of the curve, of the interest rate curve, where a lot of liabilities are. You know, certainly if the Fed raises rates on the short term, that's going to change short-term rates, but it might not impact pension plans. Nevertheless, you know, glide paths address the fact that you can have multiple ways to increase funded status.